Welcome, everyone. Today, we are diving deep into a powerful tool that many traders rely on to make smart decisions. This is all about the exponential moving average, also called the EMA. By the time we finish, you will know exactly what the EMA is, how to use it, and why it is a favorite for many traders out there. Whether you are just starting your trading journey or you are looking to sharpen your skills, this will help you spot trends, time your trades better, and improve how you approach the market. Let us jump right into it. To get us started, imagine you have a tool that lets you see exactly where the market is headed, giving you insights ahead of most others. That is exactly what the exponential moving average does. The EMA is not just any average, it is designed to help traders understand how prices are evolving while focusing on the most recent changes. Think of it as having a pair of glasses that let you see what's happening in the market right now, with much more clarity than looking at an overall average. This sharper focus helps you spot trends early and make more informed decisions. Instead of treating every day in the history of a stock the same, the EMA emphasizes recent events, which can give you a better sense of what might happen next. When using the EMA, it is important to understand how chart patterns can complement this tool. Chart patterns provide visual cues about the behavior of market prices and can indicate continuation, reversal, or indecision phases. Let us explore some key chart patterns and how they relate to the EMA. Double tops and double bottoms are classic reversal patterns. A double top forms after an uptrend and signals a potential reversal when the price reaches a high point twice and then fails to break through, indicating resistance. When a double top forms and the price drops below a significant EMA, it can confirm that the upward momentum is weakening and a downtrend is beginning. Similarly, a double bottom is a bullish reversal pattern that forms after a downtrend. When the price breaks above a key EMA after forming a double bottom, this can be a strong indication that an upward trend is beginning, especially if accompanied by increased volume. Head and shoulders is another powerful reversal pattern. This pattern consists of three peaks, with the middle peak being the highest. The neckline of the pattern serves as a key support level. When the price breaks below the neckline and a long-term EMA, it can confirm that the trend is reversing from bullish to bearish. An inverse head and shoulders pattern works similarly but indicates a bullish reversal. If the price breaks above the neckline and an EMA, it provides further confirmation of an upward move. Triangles are continuation patterns that traders often use to identify periods of consolidation before a breakout. There are three types of triangles: ascending, descending, and symmetrical. Ascending triangles are characterized by a rising lower trend line and a flat upper trend line. They often indicate a bullish breakout, especially when the price moves above the upper boundary and a relevant EMA. Descending triangles have a descending upper trend line and a flat lower trend line, often indicating a bearish breakout when the price falls below the lower boundary and a key EMA. Symmetrical triangles have converging trend lines and can break out in either direction. Traders look for EMA alignment to help confirm the direction of the breakout. Flags and pennants are continuation patterns that occur after a sharp price movement, resembling small channels or triangles. Flags move against the prevailing trend, while pennants have converging trend lines. When the price breaks out of a flag or pennant and crosses an EMA in the direction of the prevailing trend, it often signals a continuation of that trend. The EMA helps confirm whether the breakout is likely to succeed. Rounding bottoms, also known as saucer bottoms, are long-term reversal patterns that signal a gradual shift from a downtrend to an uptrend. These patterns are often seen in conjunction with long-term EMAs, such as the 50-day or 200-day EMA. When the price gradually moves above a long-term EMA, it can confirm that the downtrend is ending and a new uptrend is starting. Wedges are also important patterns that can indicate both continuation and reversal, depending on the slope of the pattern. Rising wedges are typically bearish, especially when they occur after an uptrend, signaling a potential reversal. When the price breaks below a rising wedge and a key EMA, it is often a strong signal of an impending downtrend. Falling wedges are typically bullish, often forming after a downtrend and signaling a reversal to the upside. When the price breaks above a falling wedge and crosses a key EMA, it provides confirmation of a bullish move. By combining these chart patterns with the EMA, traders can significantly enhance their ability to spot market trends and potential reversals. The EMA provides a dynamic level of support or resistance, while chart patterns provide the context for potential price movement. Together, they offer a clearer and more comprehensive view of the market, making it easier to spot trading opportunities and avoid false signals. Let us also talk about the importance of chart patterns when using the EMA. Chart patterns can give traders visual cues about potential movements in price. Common patterns include double tops, double bottoms, head and shoulders, and triangles. When these patterns form near an EMA, they can provide additional confirmation of what the EMA is already suggesting. For instance, a double bottom is a bullish reversal pattern that appears after a downtrend. If a double bottom forms and the price breaks above a key EMA, this can be a strong signal that the trend is reversing upwards. Similarly, a head and shoulders pattern is often seen as a sign of a trend reversal. If the neckline of the head and shoulders is broken, and this break occurs alongside a crossover of the EMA, it can give traders even more confidence that a downtrend is starting. Triangles are another important chart pattern that can help traders. There are ascending, descending, and symmetrical triangles, and each of these has its own meaning in terms of market direction. When you see a breakout from one of these triangles and it aligns with an EMA signal, it can provide a very strong indication that the price will continue in that direction. By combining EMAs with these chart patterns, traders can increase their chances of making successful trades. The EMA helps with timing, while the chart patterns give context and a broader picture of potential price movements. This combination makes it easier to spot opportunities and avoid false signals. Many traders compare the EMA to the simple moving average, which is often called the SMA. The difference is that the SMA gives equal importance to every single day in the period you are looking at. If you look at a 10-day SMA, every one of those 10 days gets the same attention. On the other hand, the EMA places more weight on what happened yesterday than what happened 10 days ago. This means the EMA will react faster to any changes happening now. This faster reaction can be very helpful. Picture this. You want to know if a stock is going to continue going up or if it might start to drop. The EMA helps you catch these changes early. It is like having a sharper pair of eyes that can tell you what is happening right now rather than what was happening a week ago. This makes it a favorite tool for traders who want to be ready to move quickly. Now let us talk a bit about how the EMA is calculated. This can sound complicated, but I will keep it simple. The idea is that you start with the current price of the stock. Then you use something called a smoothing factor, which helps give more weight to the recent prices. You add this number to the previous EMA value, and there you have it. The key thing to remember here is that the EMA makes the most recent prices more important. Why is this important? Well, if the market is moving quickly, the most recent prices are usually the ones that matter the most. Let us imagine you are looking at a 10-day EMA. Today's price will have a bigger effect on the average than the price from 10 days ago. This means the EMA is giving you a clearer picture of what is happening now, instead of just an average of what has been happening over the last 10 days. It is like looking at a painting and seeing all the details up close rather than just seeing it from far away. Different traders use different time frames for their EMAs depending on what they are trying to do. Let us explore how different time frames are used and why they matter. If you use a short-term EMA, like a 5-day or 10-day EMA, it will react very quickly to changes in price. This is very useful for day traders who need to catch every small movement. Day traders need to be in and out of trades quickly, and they need information that is up to the minute. In addition to choosing the right EMA timeframe, understanding chart patterns can greatly enhance trading decisions. Chart patterns such as double tops, double bottoms, head and shoulders, triangles, flags, and pennants are crucial in identifying potential market moves. For instance, a double top is a bearish reversal pattern that occurs after an uptrend. When combined with an EMA, if the price breaks below the EMA after forming a double top, this can indicate a strong signal to sell. A double bottom, on the other hand, is a bullish reversal pattern that appears after a downtrend. When the price breaks above a key EMA following the formation of a double bottom, it can be a strong indication of an upward trend beginning. Head and shoulders patterns are also useful as they often signify a reversal. If the neckline of the head and shoulders is broken while crossing below an EMA, it adds more confirmation to the potential trend reversal. Triangles are another essential chart pattern that traders use. There are 3 types: ascending, descending, and symmetrical. Ascending triangles are bullish and often signify that the price is likely to break out upward. If an ascending triangle forms and the price moves above the EMA, it provides extra confidence in a bullish breakout. Descending triangles are bearish and often indicate a breakdown in price. When the price falls below both the descending triangle and a key EMA, it signals that a bearish move is likely. Symmetrical triangles can break out in either direction, and when combined with EMA signals, they can provide additional guidance on which way the market might move. Flags and pennants are continuation patterns that often appear after strong price movements. A flag pattern looks like a small channel that moves against the prevailing trend. If the price breaks out of a flag pattern in the same direction as the trend and crosses a key EMA, this can be a very strong indication that the trend will continue. Pennants are similar to flags but have converging trend lines that look like a small symmetrical triangle. If price movement breaks in the direction of the trend and crosses the EMA, it signals a continuation of that trend. These chart patterns, when combined with EMA signals, can give traders a more complete view of potential price movements. By understanding both the EMA and the various chart patterns, traders can make better informed decisions, spot opportunities early, and avoid being misled by false signals. The key is to always look for confirmation between the chart patterns and the EMA before making trading decisions. If you are looking at a medium-term EMA, like a 12-day or 26-day EMA, you are getting a balance. Medium-term EMAs react a bit slower, so they smooth out some of the noise in the market. This makes them great for swing traders. Swing traders hold their trades for several days or maybe even weeks. They do not need to be as fast as day traders, but they do want to catch trends early enough to make a profit. And then there are the long-term EMAs, like the 50-day or 200-day EMA. These are used by traders who are looking at the big picture. These traders want to know if the entire market is changing direction. Long-term investors use these EMAs to spot major shifts that might mean it is time to buy more or sell off their holdings. Let us now get into how to use the EMA to spot trends. This is really where it gets interesting. If the price is above the EMA, it usually means the market is in an uptrend. This means that traders might look to buy or hold what they already have. On the other hand, if the price is below the EMA, it signals that the market is in a downtrend. This means the market is getting weaker and it might be time to sell or avoid buying more. One of the most powerful ways to use the EMA is to look for moments when the price moves above or below the EMA after staying on the other side for a while. For example, if the price has been below a long-term EMA for a long time, but then moves above it, this can be a sign that a new uptrend is beginning. The opposite is true as well. If the price has been above a long-term EMA and then drops below it, that can mean a downtrend is starting. Another strategy that traders use with the EMA is called the crossover. This is when you use two different EMAs, one short-term and one longer-term, and look for the point where they cross each other. A bullish crossover happens when the short-term EMA, like a 12-day EMA, moves above a longer-term EMA, like a 26-day EMA. This means that buying momentum is building, and it can be a great time to consider buying. A bearish crossover is when the short-term EMA moves below the longer-term EMA. This means that selling pressure is increasing, and it can be a signal to sell or avoid buying. Crossovers can be further enhanced by considering additional chart patterns. For example, if a bullish crossover occurs along with the formation of a double bottom pattern, this combination can provide a much stronger signal that an uptrend is beginning. Similarly, if a bearish crossover is seen at the same time as a head and shoulders pattern, this further reinforces the likelihood of a downtrend. Another useful technique is to observe how crossovers behave during different market phases. During periods of consolidation, crossovers can occur frequently, leading to false signals. In these cases, it is helpful to wait for a breakout from a clear chart pattern, such as a triangle or flag, before acting on the crossover signal. For instance, if a bullish crossover happens right after the price breaks out of an ascending triangle, it can be a strong confirmation of an uptrend. Traders also sometimes use multiple crossovers to get more reliable signals. For example, a combination of a short-term EMA, a medium-term EMA, and a long-term EMA can help reduce false signals. A bullish signal may be confirmed if the short-term EMA crosses above the medium-term EMA, and then both cross above the long-term EMA. This sequence shows increasing buying momentum across different timeframes, adding more confidence to the trade. It is also important to consider the slope of the EMAs. If both the short-term and long-term EMAs are sloping upwards and a bullish crossover occurs, it is a stronger signal compared to when the EMAs are flat. The upward slope indicates that the overall trend is positive, making the crossover signal more reliable. Conversely, if both EMAs are sloping downwards, a bearish crossover is a stronger indication of a continuing downtrend. These crossovers are popular because they are clear signals that tell traders what to do. If you see a bullish crossover, it is a cue to enter a trade. If you see a bearish crossover, it is a sign that it might be time to get out. Many traders love how simple and direct these signals can be. Another way traders use the EMA is by treating it as a support or resistance level. In an uptrend, the EMA can act like a dynamic support line. This means that if the price falls back but then bounces off the EMA and continues to go up, it tells traders that the trend is strong. On the flip side, in a downtrend, the EMA can act like a resistance line. This means that if the price rises but struggles to break above the EMA, it suggests that the downtrend is still going. For instance, during a bull market, traders often look at the 50-day EMA as a support level. If the price pulls back to that EMA but does not fall below it, it can be a good sign to buy, expecting the price to continue rising. While the EMA is a strong tool on its own, it becomes even more powerful when combined with other indicators. A great partner for the EMA is the Relative Strength Index, also known as the RSI. The RSI tells you if a stock is overbought or oversold. If you see a bullish EMA crossover and the RSI is showing that the stock is oversold, that is a strong signal that it might be a good time to buy. Another useful indicator is the moving average convergence divergence, called the MACD. This indicator is based on the difference between two EMAs. If both the EMA and MACD are showing bullish momentum, it is a very strong confirmation that the price is likely to go up. The MACD is especially helpful when looking at chart patterns like double tops, double bottoms, or head and shoulders. For example, if you see a double bottom forming and the MACD is crossing upward, this can add more confidence that the price will reverse higher. In addition to the MACD, understanding volume is crucial when analyzing chart patterns with the EMA. Volume provides insight into how many traders are participating in the move, which can indicate the strength of the signal. For instance, if a bullish crossover of the EMA happens during a breakout from an ascending triangle and there is high volume, it strongly suggests that the upward move is genuine. Conversely, if you see an EMA crossover but it is happening with very low volume, that signal might be weak. When there is high volume, it means that more people agree with the move, and the signal is likely to be stronger. Another chart pattern where volume and the MACD can add valuable context is the flag or pennant. When the price breaks out of these continuation patterns, checking if the MACD confirms bullish or bearish momentum, and if there is accompanying high volume, can make a significant difference in avoiding false breakouts and capturing reliable trends. Like anything else, using the EMA takes practice, and there are some mistakes traders often make. One of the most common mistakes is acting too quickly when they see a crossover without waiting for confirmation. Always look at other indicators like volume or the RSI to make sure that the signal is strong. Another common mistake is overreacting to small price movements. The EMA is very responsive, and it is easy to get caught up in every little move. Make sure you are seeing a clear trend before making any big decisions. And finally, remember to consider the bigger market context. Even if the EMA is telling you to buy or sell, always think about what is happening in the news or in the broader economy. Market conditions like economic reports or major news events can affect your trades, no matter what the EMA says. Before you start using the EMA with your money, it is a good idea to practice. A great way to do this is by using a demo account. This allows you to trade with pretend money and get comfortable with spotting trends and crossovers. You can also keep a trading journal. Write down why you entered a trade, what you saw in the EMA, and what happened after. This will help you learn from your mistakes and successes. Another tip is to experiment with different time frames. Try using short-term, medium-term, and long-term EMAs to see which one works best for your trading style. You might find that a 5-day EMA works well for some trades, while a 50-day EMA works better for others. In addition to experimenting with different time frames, understanding how different chart patterns behave in conjunction with various EMAs can help refine your strategy even further. For example, when working with a short-term EMA, such as a 5-day EMA, patterns like flags and pennants can help indicate continuation in a trend after a sharp movement. In these cases, using the shorter EMA helps to quickly identify if the trend will continue. On the other hand, longer-term EMAs like the 50-day or 200-day EMA are often best paired with larger chart patterns, such as head and shoulders or double tops and bottoms, which indicate more significant trend reversals. When these long-term EMAs confirm the breakout from these chart patterns, the signals are usually much more reliable, indicating major shifts in the market. Symmetrical triangles, descending triangles, and ascending triangles can be particularly useful across different time frames. Short-term EMAs can help catch breakouts from these triangles early, especially when combined with rising volume. For longer-term strategies, these patterns forming near a 200-day EMA can signify substantial market shifts, which are especially important for long-term investors. The combination of chart patterns with different EMAs can help traders not only in timing their entries and exits, but also in understanding the broader context of the price movement. By understanding which chart patterns align best with specific EMA timeframes, traders can make more informed decisions and adapt their strategies to different market conditions. This helps to avoid relying solely on one type of signal and provides a more well-rounded approach to trading. To wrap it all up, the exponential moving average is a very powerful tool that can help you spot trends, decide when to buy or sell, and understand support and resistance levels. It reacts faster than the simple moving average, making it a favorite for traders who want quick signals. The best way to get better with the EMA is to practice. Add EMAs to your charts, experiment with different time frames, and always look for confirmation from other indicators. If you are curious to learn more or have questions, do not hesitate to share your thoughts. The more you ask, the more you learn. The EMA is a key tool for traders, and with enough practice, you will learn to use it well. Stay disciplined, keep learning, and you will see the difference in your trading decisions. Thanks for being here, and good luck out there.